And by the way, your quiz number 3, I looked at the grades, and most of you did really, really well on that. And let me remind you again that the grades, and I'm sure there's a way to do this, okay? But it's just, and so, if you're listening to what I'm saying, going, well, hey, you can change that. Maybe I can, but it's not going to get changed this semester, okay? The grades on Canvas are not weighted accordingly. And so if you have a bad quiz grade, let's say, for example, you really screw up and you make a 40 out of 100 on the quiz grade, it's going to count that quiz grade equally as a test grade. So it's going to pull your average way down. But the thing is, tests count 26% of your grade, quizzes count 6% of your grade, and I dropped the lowest quiz grade. So don't panic if you see make a low quiz grade and look at your score and go, wow, look, it brought me down from an 80 to a 60. Well, that's not going to happen. I don't care if you make a 0 on a quiz, it can only bring you down at the most 6 points in your average. Okay? So don't worry about that. It's not weighted accordingly. All right, so chapter 7, stock valuation. Now, when chapter 6, we talked about bonds, and we said that bonds are a form of debt. Now, taking a step back and looking at the big picture, basically in chapter 6 and chapter 7, we're talking about ways, well, two things. One is ways that companies can raise money to invest in various projects. So if a company wants to expand, if they want to build a new factory, if they want to build a new warehouse, if they want to introduce a new product line, if they want to increase research and development, that takes cash. And they have to raise that cash somehow. So they can go to the bank and borrow the cash. If they have retained earnings, they can dip into their retained earnings, which is kind of like their savings account for the cash. They can issue bonds, which we talked about in chapter 6. Bonds are a form of debt. The interest payments and the principal payment on bonds are legal obligations. The company has to make those payments, okay? They don't have a choice. Or they can issue shares of stock. They can issue preferred stock or they can issue common stock. So that's what we're going to talk about in this chapter. And stock is a form of equity or a form of ownership. So if you buy stock in a company, you're hoping that two things are going to happen. One is you're hoping you're going to receive dividends most of the time. There are times when if you don't receive dividends, that's okay, because also you want the price of the stock to go up. And if the price of the stock goes up fast enough, you're not worried about dividends. Okay, some really good examples of that. Microsoft is a really good example of a company that went for years and never paid dividends. The reason is Microsoft was growing so fast, they were taking all of their earnings, and instead of paying it out to stockholders, they were reinvesting it in the company, and the company kept getting bigger and bigger and bigger and more valuable. Now, stockholders of Microsoft didn't complain because the price of the stock kept going up and up and up and up and up, and it would split 10 for 1, 5 for 1, 2 for 1, and it would go up again, it would split again. And so if you're making just huge returns on stock prices, you're not worried about dividends. Okay, but that's essentially the two ways that you can make money in the stock market. And I'm not including things like short selling, in which short sales, you hope the price of stock actually goes down, or derivative instruments. And we really won't get into that too much in this class. All right, so this is just sort of a summary of how stocks and bonds work. You can see, for example, a voice in management. Debt doesn't have really much say-so when it comes to management. Equity does, because stockholders get a vote. Typically, it's one vote for every share of stock they own. So when it comes to electing who serves on the board of directors, stockholders have a say-so in that. Bondholders don't. When it comes to changing certain policies within the corporation, they might have a vote of stockholders. And so the more stock you own, the more power you have in terms of the future of the company. Claims on income and assets. Debt holders come first. Bondholders come at the very end, especially stockholders come at the very end, especially common stockholders. The maturity of bonds, they have a stated maturity. Stock, at least technically, does not have a maturity date. And then the tax treatment for interest payments are tax deductible. They're an expense for companies, which is a good thing. When a company pays dividends on its stock, that is not tax deductible. So it is treated differently. Okay, so, and this basically summarizes what I just talked about here. Okay, the stockholders have voting rights, and they can basically help to set the tone and the direction of the future of the company. All right, now this is talking about bankruptcy, and we're going to talk about that a little bit more later. But basically what it's saying is, if a company files for bankruptcy, stockholders are going to be at the very, very bottom of the list of people who are paid. And what that means is, for stockholders, is they're going to receive nothing if a company goes bankrupt. Because by the time they start paying off, and it talks here about how you pay secured creditors first, and then unsecured creditors, and finally at the very, very end, you've got common stockholders. And I can tell you, there's not going to be anything there for stockholders. So in a bankruptcy situation, in a liquidation situation, stockholders are going to lose everything they've invested in the company. That's why stockholders expect a higher return on their investment than would bondholders, because they're taking more risk. So if you take more risk, as we've learned during the semester, you expect a higher rate of return. It doesn't mean you're going to earn a higher rate of return, but it means you expect a higher rate of return. Okay. Okay, we've talked about this. We've talked about this. Okay, two different types of stock. We're going to come back and take a look at common stock a little bit later. Let's talk about preferred stock really quickly. When a company wants to raise capital, as I said, they can issue common stock or preferred stock. As the name implies, common stock is the most frequently used. It's the most common. But preferred stock is often used by companies, but preferred stock is a little bit different because it has some characteristics of debt and some characteristics. So it looks like a bond in some ways, and it looks like common stock in other ways. For example, its bond characteristics or debt characteristics. Preferred stock has a par value. Well, common stock also has a par value, which we'll see in just a minute. Preferred stock pays a fixed dividend, which takes a senior position to common stock dividend. Now, what that means is, let's say you've got common stock that has a $100 par value. Preferred stock has a $100 par value. And you've got a 6% preferred stock. That means it's going to pay 6% of $100 each and every year. Common stock dividends aren't that specific. Common stock dividends can go up. Common stock dividends can go down, although it sends a very negative signal to the market. And so, or they can simply not be paid at all. Now, when it comes to preferred stock dividends, it says that these take a senior position to common stock. There's two different types of preferred stock. One is called cumulative, the other is called non-cumulative preferred stock. The difference is pretty significant. What it means is, let's say that a company has they've got preferred stock and common stock, and they have a really bad year. So they don't have money to pay their preferred stock or their common stock dividend, because the way it would work is, if they had enough money, they would pay preferred stock dividends first, and then they would pay common stock dividends. But let's say, for example, they can't even pay their preferred stock dividends this year, but they have cumulative preferred stock. What that means is, any preferred stock dividends that they pass on this year or next year or the year after, before they can make another common stock dividend payment, they have to go back and make up any missed preferred stock dividends. That's called cumulative preferred stock. If it's non-cumulative preferred stock, then if they miss the preferred stock dividends, that's okay. they can, when they start making money again and when they can pay a preferred stock dividend, they're going to pay it. They don't have to go back and make up any missed preferred stock dividends. And then they're going to pay a common stock dividend if they have the money. But they're always going to pay preferred stock first. And then some of the equity characteristics. Again, common stock also has a par value, although it has really little meaning. And dividends can be passed if financial conditions warrant, which we just talked about. But again, it makes a difference as to whether it's cumulative or non-cumulative. All right. Common stock. Okay, so when we talk about the stock market, and when you look at, for example, stocks being bought and sold, like we just looked at on the Scott Trader streaming quotes, we're typically referring to shares of common stock. And as you can see here, it says common stockholders are sometimes referred to as residual owners of the company. What that means is they're owners, but they get paid last. And as we talked about earlier, if there are financial problems, if there's bankruptcy looming, or if a company does file bankruptcy, financial stockholders or common stockholders are at the very end of the financial payout. So essentially, you get nothing when that happens. This is a key point here with stock. Stockholders are sure of only one thing: they cannot lose any more than they have invested in the firm. So if you buy $1,000 worth of stock in a company and that company goes bankrupt, the most you can lose is $1,000. If you have, for example, a sole proprietorship, which we talked about way back in chapter 1, and your company goes bankrupt, your creditors may be able to come after your business assets, and they also may be able to come after your personal assets. Okay, that doesn't work in the stock market. You can only lose as much as you've invested in the company that you own. And as we talked about earlier, because of this uncertainty, and again, uncertainty is a huge part of investing, common stockholders expect to be compensated with adequate dividends and ultimately capital gains, which simply means the price of the stock goes up. I mean, that's what we're hoping when we purchase a stock, is the price of the stock goes up. And you hear the saying, you want, well, within the stock market, it's pretty simple. You want to buy low and sell high. And that's true. The problem is, when is a low price for a stock? When is a high price for a stock? And you may think, well, okay, if you buy low, that's the worst part, because then you don't have to worry about selling it when the price goes up. Well, when do you sell? And I'll show you some examples when we get back to the streaming quotes. I'll go back and show you some examples of stocks that I've purchased in the past. And I've done it for years. I'll buy a stock. I'm always a positive person, okay? A glass half full kind of person. And that even works with my investments. And so I'm always thinking, if the price of a stock goes up, it's going to keep going up. And so I'll watch it go up. And then if it starts dropping off, I'm still positive. I'm thinking, okay, it's just a temporary dip. The price is going to go back up. And I'll watch it go from a high down and down and down and down and down. Sometimes it'll go back to the price I originally purchased the stock for. And so a couple of examples that I'll show you a little bit later, maybe not today, but maybe on Tuesday. One was Netflix. That's one of my biggest blunders ever when it comes to investing, was buying Netflix early at a really good price, watching the price of the stock go up, thinking I don't need to be too greedy, I should sell and take my gain, which I did, and then watching the price of the stock quadruple over the next year. You know, I'd made a 30% return in a month, and I was so excited. And I'm like, man, I'm not doing this again. I'm selling. I'm taking my 30%. I'm going to be happy with a 30% increase in 1 month. And then I was sick for the next year as I watched it go up and up and up and up and up. Another example of that is Tesla Motor Company. I bought Tesla early, went up 25, 35%. In a short period of time. I sold it thinking, man, I am so smart. I bought it early, I sold it, I've got my big gain, and then I watched it triple in price over the next 10 months. So again, you think, well, buying low may be the hard part. Buying low is not really the hard part. It's determining when do I sell, when am I happy with my gain. Because if you watch these stocks, I mean, you can watch them make these nice increases, and then sometimes they just nosedive. So you have to know when to get in and get out. That's one of the toughest things. Okay, so let me skip through some of this. Par value. We talked about this a little bit when we looked at the financial statements of a company, but it says the par value of common stock is an arbitrary value established for legal purposes. So what that means is when you're looking at a balance sheet and you're looking at the stockholders' equity section of a balance sheet, and it says common stock, I don't know, $2 par value or $3 par value, whatever, that means absolutely nothing as an investor. Okay. Now, when it comes to bonds, the par value does mean something. We said the par value is typically $1,000, and that has some meaning to us. It's important to us when it comes to valuation. But when it comes to common stock, par value means nothing to us. These are some terms, just some terms you might want to be familiar with, and most of these are pretty self-explanatory. Authorized shares, these are the number of shares that the firm's charter allows it to issue. So you may have some companies that have 1 million shares outstanding. Some companies may have 100 million shares outstanding. And some may have 500 million shares. I mean, we just saw that, which one was it? Citibank had, 30 million shares, something like that. I don't remember how many, but it just changed hands just today. So that's a lot of shares of stock outstanding. The outstanding shares. Now, authorized is how many they can issue. Outstanding is how many they have issued. Treasury stock. Now, this comes up a lot of times in the investments area. It says treasury stock are shares of common stock held by the firm. Often these shares have been repurchased by the firm. So this is one way that a company, if they want to reduce the number of shares outstanding, the shares don't mature. We talked about common stock doesn't have a maturity date, but the company can buy back shares of its own stock. And typically, they're going to do this for one reason, and that is they think the shares are underpriced. They think the shares are really cheap right now compared to what they should be selling for, and so the company buys back some of its shares. Now, when you see a corporation buying back its own shares, again, that's part of the signaling process. And I said signals are a really important part of investing. So when you see a company sending that signal, they're buying back shares of their own stock, investors take that as, wait a minute, this company, the shares must be underpriced. Something big is coming in the near future that's going to push the price of the shares up. So the company's buying back some of their shares right now. I need to jump into the market. I need to start buying some of these shares of stock because it's sending a really positive signal that the price is going to go up in the future. Now, I'm not saying that's true all the time. I'm just saying that's the signal that it sends when you see a company buying shares. And if you happen to see a company selling shares of stock and it already has shares outstanding, that sends two signals. One is a positive signal that they think the price, actually, a couple negative signals. One, they think the stock might be overpriced currently, so they're going to try to sell more shares and make more money in terms of equity. Secondly, when a company sells shares of common stock, that's the most expensive form of financing you can have. It's more expensive than bank loans. It costs them more than issuing bonds. It costs them more than issuing preferred stock. And so when investors see an existing company with existing shares of common stock issuing more shares, that sends a negative signal that they're having financial problems because they're using the most expensive form of financing possible. And they wouldn't do that if they could use a cheaper form of financing, but apparently they can't. So it's very similar to you. If you see one of your friends, let's say you've got a friend and you think they're doing pretty well financially, and you see them walking out of a local check cashing company, a title loan company that charges 40% interest, Now, typically, people go and borrow money at those places when they have no other options. Because if you go to your local bank, they may charge you 6% interest. But the check cashing company may charge you 40%. So why would you go there unless you had no other options? Well, that's what it says when a company issues shares of common stock. When it has previously issued shares, that's the most expensive form of financing. Why are they doing that? There must be problems. A lot of times you find out late because the company has to report that if it's a publicly held corporation. But a lot of times you won't see that until you see what's called their 10Q report, which is filed with the SEC. That's their quarterly report, and it would show that they have been purchasing shares of stock. Yeah, so a lot of times like that day, you don't realize they're purchasing shares of stock. But you can look at it. Also, they have to report if any of their board members or executive officers buy shares of stock. And so if you see the company president or executive vice president or members of the board of directors stocking up on shares of stock, buying a lot of them, again, that sends a pretty positive signal. Maybe there's something good that's going to happen in the future. They haven't told us about it yet, but I'm going to invest based on that signal that they're buying, so I'm going to buy. Good, really good question. All right, and then issued shares, combination of outstanding shares plus treasury stock. All right, this is what I was talking about earlier. This is the stockholders' equity portion of a balance sheet. So for example, here it says this company has common stock. It has an 80-cent per share par value. Well, basically that means nothing to it. They've authorized 35 million shares. They've issued 15 million shares, paid in capital in excess of par. So what this means is if you took the 12 million and the 63 million, added them together, which is $75 million, divided by 15 million, this stock originally sold with this initial public offering at $5 per share. That's 75 million divided by 15 million, which gives us $5 per share. Now, just because it's sold for $5 per share, that doesn't mean that it's selling for $5 per share now, because what's on the books, on the balance sheet, has nothing to do with what the market price of the stock is. Because once the stock is sold by the corporation doesn't get a benefit from that stock in the future. They sell it one time with the initial public offering, which we'll talk about a little bit later, and then that's it. So if I log into my Scottrade account today and buy 100 shares of Citibank, Citibank doesn't benefit from that. I'm buying it from somebody who is previously on the stock. They want to sell it. I'm buying it. So it's just like buying a used car. When I buy a used General Motors car, it doesn't benefit General Motors. They only benefit when somebody buys a new General Motors car. But when I buy a used one, or Ford or whatever, they don't benefit. It's the same way with secondary stock market transactions. The company doesn't benefit. Okay, so, all right. So, basically, a couple of terms here. Is there such a thing as an undervalued or overvalued stock? Well, that's a really big question. We're going to spend just a few minutes talking about that because some people say, yes, there are undervalued and overvalued stocks. Other people are going to say, no, there's not. If a stock is selling for $14 per share right now, it is worth $14 per share. They're never undervalued, they're never overvalued because our stock markets are efficient. But again, some people don't believe that. So an undervalued stock would be one that investors want to buy, and an overvalued stock would be one investors want to sell. So if you currently own it, you think it's worth, it's selling for more than it's worth, you want to get rid of that stock. Okay, now, some different stock market transactions. You need to know these definitions for the final exam. Okay, so we've got three different types here: primary market, secondary market, and IPO. I'm actually going to start at the bottom first with IPO. The IPO stands for Initial Public Offering. And this is when a stock goes public for the first time. So you've got a company, you've got one of the bigger IPOs. Twitter was a big IPO a couple years ago. Facebook about 4 years ago. Alibaba, which was a Chinese IPO, biggest one ever. That means that the company was privately owned at one time, but the owners want to now go public. And so when you do that, the way it works is you get an investment banker, and there's some slides in this chapter regarding investment banking, but you work with an investment bank and they help you sell shares of your company to the public. Now, this is a very complicated process. It's a very expensive process for the corporation issuing the shares, and it's a money-making process for the investment bank working with the corporation. If you are now, when I say investment banker, that's not the same as the kind of bankers that you see if you go into your local bank to cash a check or to make a deposit, okay? An investment banker is completely different. But if you're a really good investment banker, you can make a tremendous amount of money. I'm talking millions and millions of dollars per year. If you're working with the big deals, the thing is, it's a high pressure job. You have to be extremely good, because if you get it wrong just one time, you can cost your client literally billions of dollars in lost equity. For example, I'll give you an example. When Facebook went public, they went public at a stock price of $35, I think it's $35 per share. So that's the price that the investment bank, now they actually had to work with several investment banks called a syndicate, because their deal was so big, one investment bank couldn't handle it. So they had to split it up among several. But they priced it at $35 per share. Now they sold all of the shares, raised billions of dollars. But what if the investment bank pricing that deal decided, well, it's not worth $35 per share, it's worth $30 per share. And they sold all of their shares. But if you think about it, $5 per share difference times hundreds of millions of shares could easily have cost the company a lost $1 billion in equity. Just by mispricing one share of stock by $5, multiply it by hundreds of millions, that adds up. Now, if they had priced Facebook stock at, say, $40 per share, and investors looked at it and said it's not worth $40, then they wouldn't have been able to sell all of the shares of stock. And that would have also cost the company billions of dollars in lost equity. So you have to be very accurate when you're setting the price of a stock when you're selling it for the first time. And good, I will let you in on a little investment secret. Now, I don't know your financial position, or if you buy and sell stocks, or if you're a millionaire or whatever. But I will tell you that when it comes to an initial public offering, unless you're a pretty wealthy individual who does a lot of business with brokers, if somebody calls you wanting to sell you shares of an IPO, you need to just thank them for calling and hang up. The reason is that when it comes to a good IPO, and any IPO, they start with their best customers first, the ones that invest millions and millions of dollars each year. So they just think of a list. You've got the wealthiest at the top, you're working your way down, so these investment bankers are calling saying, hey, we've got shares of Facebook, can I put you down for 100 or 1,000 or 10,000 or whatever? The good investors know it's a good investment, so they're going to snatch up the shares first. So guess what? I never got a call about the Facebook IPO because they ran out of shares way before they would have gotten to me. Okay, I'm way down here at the bottom of the list, okay? I have had calls about shares of an IPO. Typically, they'll call, they'll say, I've got shares of some company. It's going to be a company I've never heard of. And what that means is, if they made it down to me, from the top of the list all the way to the bottom of the barrel, and they're calling me to buy shares of an IPO, I don't want any part of it. Because everybody else above me has turned it down. They've said, nah, I'm not interested. I've never heard of this company. It's probably going to be bankrupt in 6 months. I don't want to buy shares of it. So now they're calling me, and so I'm just telling you that the first time you get a call about an IPO, it kind of makes you feel pretty good. Because you're thinking, wait, I heard about this in my finance class. Yeah, this is a company going public. I've heard people make a lot of money when they invest in IPOs. And you can if it's the right IPO. But if they're calling you because nobody else wanted to buy it, you probably shouldn't buy it either. Okay, so that's an IPO. Now, when we're going to go back up to the top now. A primary market transaction is when a company that's public already, they have already issued shares of stock, but they are now selling additional shares to the public. So this would be, for example, if Ford Motor Company, who's had shares outstanding for 100 years, if they decide to issue new shares of stock. Well, as I said earlier, common stock is the most expensive way to raise money. And so if you see Ford Motor Company issuing new shares of stock, what that says is the company's having financial problems. There are cheaper ways for them to raise money, but apparently they're not using those ways because they can't. And so that sends a negative signal to investors, and you're going to see it push down because of that negative signal. But that is when brand new shares are being sold, a primary market transaction. And then a secondary market transaction, that's what we typically think of when we buy stock. It's when you have seasoned, you can also call them previously owned. If we were in the car market, we would call it a used car. These are used shares of stock. Somebody else owned it, you bought it, you don't care who owned it, it doesn't matter to you. Or if you sell, you don't care who buys it. You're just buying and selling at a specific price in the secondary market. So all of the share prices that we saw earlier on the screen changing price up and down with the green and red blocks, those were secondary market transactions. That was people buying and selling literally hundreds and hundreds of millions of shares of stock each and every day. So you need to know the difference between these three different types of market transactions. And then when it comes to valuing common stock, there's different ways that you can do this. We're going to focus on what's called the dividend growth models. And these are really simple, actually. You don't need your financial calculator. There's a really easy formula. You just plug the numbers in and do the calculation. But you can also use something called the free cash flow model, the book value approach, the liquidation value approach, or the PE multiple approach. So there are different ways. None is perfect. Oftentimes, the best way to value a stock is to use a combination of these to determine, what is it worth? What's the average price that I'm coming up with using 3 or 4 different valuation models? A lot of times, common sense goes a long way towards determining what a stock is worth or determining what a stock is going to do in the future. For example, the Netflix example that I gave you earlier, you could see pretty early on that Netflix, which most of you probably don't even remember this, when Netflix actually would mail you movies on a DVD, and so you could be, subscribed to the 1 DVD program or the 3 DVD program, so you could have 1 out at a time or 3 at a time. So the way it would work is they would mail you the movie, you would watch it, you put it back in the package, and you mail it back to Netflix. And that's how they started. Well, when the digital streaming came about, you could see it was heading that direction. And there was no doubt about it. It was going that direction. And so they decided to split their digital streaming and their mail order business. Now that was a huge issue for Netflix. And a lot of investors thought, man, that is the worst decision they've ever made. Because what happened is you had one plan where you could stream and you could receive the mail order DVDs. Or now they were going to split it up where you could have the mail order, you pay one price. You could have the streaming, pay one price. But you had to have, one or the other or pay for both. And that splitting of the price structure, they thought that was the end of Netflix. Well, you can easily see if you go back and look at Netflix stock price, you can see when that split occurred, and you can see what happened to the stock price pretty soon afterwards. Is investors decided, look, we really don't even need the mail order business any longer. That's past. Okay? The streaming is where the future is. And so Netflix started growing, and then Netflix decided, look, we also have some other options. What if we, instead of buying all of our content, what if we produce some of our own content? Produce some television shows, television series, some Netflix movies. And again, people thought they were crazy because digital streaming companies don't make their own television shows. They can't afford to. They can't afford to make their own movies. It's going to be a bunch of crap, okay? I mean, you're just going to buy content from other people and be done with it. Well, again, they went against what was traditionally the model for doing business, and it's worked out pretty well for them. I'm not saying that any future decisions they make is going to work out as well, but I am saying it's worked out really well so far. And so, as we're looking at and trying to value this, just using common sense a lot of times works almost as well as some of these different valuation models. Okay, now when you see this, this is the basic stock valuation model. Let me tell you what this says. This says that the price, the intrinsic value of a stock, or the theoretical value of a stock. So this is the P with the little caret or the tilde or whatever. What is that called? A caret? Is it a caret? Okay. I call it a hat. Okay. So I'm going to say P hat. So this says the theoretical value of a price, P hat at time period 0, which is today, is equal to the present value of the future expected dividends. So that's what the D stands for, dividend. So this is the dividend to be paid 1 year from now. And this is the dividend to be paid 2 years from now. And the dividend to be paid 3 years from now. And you'll notice we take the dividends out to time period infinity because, as we said, common stock doesn't mature. So at least theoretically, it's going to pay dividends forever. And you'll notice we're taking this dividend, we're dividing it by 1 plus the required return, raised to the appropriate time period. So if we take this information, this is simply a present value calculation. This is what we learned back in chapter 5. About 30 minutes into chapter 5 was, how do you calculate the present value of a future cash flow? Well, this is the formula right here. So you'll notice this is simply a series of present value calculations. So what this says is the value of a share of stock is the present value of the expected future cash flows, and the expected future cash flows come from two different areas. One is the dividends. Secondly, it's going to be the capital gain, which means the price going up, or the capital loss, which means the price going down. So we can take this model, and also understanding what we do about present value, what this shows us is that when we get very far into the future, for example, when we go, let's say we've got a stock, it pays a dividend of, okay, so let's say we've got a stock, pays a dividend of $1 per share. And the required return on that stock is 10%. Now this would be the present value. So if this were the present value for the first year, we would simply raise that to the first power, and somebody do the math on that. What is $1 divided by 1.1? You can stop texting long enough to move over to the calculator on your phone and do the calculation really quick. How much? 0.90? Okay, so this adds 90 cents to the price of the stock. So this is dividend 1. And then we had dividend 2, and so that would be the $1 divided by 1 plus 0.10 raised to the second power, and whatever it is, it's going to be less than 90 cents because the present value is going to get smaller the further into the future we go. So these first few dividends make a lot of difference when it comes to the price of the stock. Once you get down, for example, to dividend 50. If you do the calculation on that, 1.1 raised to the 50th power, and then divide $1 by that, you're going to have a really, really small number. I don't know what it is, but it's going to be really small. Probably a penny, less than a penny. So what this means is dividends very far into the future, time period 30, 35, 40, 45, 50, they add almost nothing to the price of the stock currently. So knowing that, and knowing that we have this basic valuation model, we're only really concerned with the first few dividends. We're not concerned with dividend 75, okay, because it's not going to add much. So we can take that and we can divide this model into two specific types of models. One is, and they're both based on the growth of the dividends. Now, the first one is listed here. It's really simple. It's called the zero growth model. And as the name implies, it assumes a stock's dividends are not going to change. So it's going to pay the same dividend this year, next year, 5 years from now, 10 years from now. The dividends aren't going to change. Basically, what we're doing is we're valuing this like a perpetuity. That was back in chapter 5 also. And also, we can use this for preferred stock because remember, preferred stock dividends were fixed. They didn't change. And so if they're not changing, they're not growing. So we can use the zero growth model for common stock whose dividends are not growing or for preferred stock. Now, here's a really simple example. This stock pays a dividend of $2 per share. You'll notice it's not changing. It pays $2 time period 1, $2 at time period 2, time period 3. And the required return on this stock is 13%. So if we wanted to calculate the current price of this stock using the zero growth model, we would simply put in the future payment, or in this case, it's the dividend, divided by the expected return. So this is your formula. This is what you'll be given on your formula sheet for the final exam. And you simply plug in the $2 dividend divided by the required return, and you come up with the expected price of $15.38 per share. It's that simple. You don't have to worry about putting things in your financial calculator. It's simply plugging numbers into the formula. So that's the zero growth model. This is using the zero growth model to value preferred stock. Here's a preferred stock. It's paying a $5 dividend each year. The required return is 10%. So we're changing this just a little bit. This says the value of preferred stock is equal to the dividend payment, which is not changing, divided by the required return. So this preferred stock should be selling for $50 per share. Again, really, really simple, really straightforward. Okay, so that's the zero growth model. So hang with me for just a minute. We need to get through this, and then I'll get you out of here. The next model is what's called the constant growth model, or another name for it is the Gordon model. And again, the name tells you, this model assumes a stock's dividends grow at a constant percentage each year. Thus the name, the constant growth model. And this is actually the model here, okay? It says the price of a stock at time period 0 is equal to D1, that's the next dividend to be paid, divided by the required return minus the growth rate. Again, it's pretty simple. You're given this information. You just plug it in. Now, one thing that's important about this model, and since this is in red with a check mark by it, you're probably going to see it again on the test. It says the dividend growth rate, G, must be less than the stock's required return for this model to work. So if you remember back to your math classes, they had what's called necessary conditions for some mathematical models. This is a necessary condition for this mathematical model to function. Now, the really hard part about this model is determining whether you're given, let me go back here, whether you're given D0 in the question or D1. And the way this works is, and you'll be able to determine this as you practice reading these problems, but D0 is the last dividend paid. And so since it's already been paid, it is not going to have an effect on the stock's price. Sometimes as you're reading the question, you're given D1. D1 is the next dividend to be paid. And it does affect the stock price. So again, D0, the last dividend paid, or D1, the next dividend to be paid. That's the key determination that we have to make as we're reading through a problem. So for example, let's say that we're reading a problem and it says ABC Corporation recently paid a dividend of $1 per share. Well, as you're reading that, you're thinking, okay, they've already paid that dividend, so they've given me D0, which is $1 per share. Well, if you're given D0, you have to multiply it by 1 plus the constant growth rate to get the next dividend that's going to be paid. Because remember, the formula is the price of the stock is equal to D1 divided by the required return minus the growth rate. So this is what we need, D1. But if you're given D0, you can calculate D1 pretty easily by simply taking the last dividend paid, multiply it by 1, let's say the growth rate is 8%. I'm just making this number up. So D1 is going to be $1.08. And if it's growing constantly, D2 is going to be how much? $1.08 times 1 plus the growth rate, whatever that is. And D3 would be D2. So that's what, when you see this part of the slide here where it says D1 is equal to D2, D3, that's what we're talking about here. Sometimes you're given D0. If that's the case, this is the part of the model you use. If you're given D1, this is the part of the model excuse me, that you use. Here's an example of a company. It recently paid a dividend of $2 per share. The required return on this stock is 13%, and the stock is expected to grow at a constant rate of 6% per year into the foreseeable future. This is D0, so we would plug it in here. We would say $2 times 1 plus 0.06 equals 212, divided by the required return of 0.13 minus the growth rate of 0.06. So we work through the math, and we find that this stock should be selling for $30.29 per share according to the dividend discount model. So is you kind of following this? If you're given these numbers and you're given the formulas, you can plug them in, no problem. Pretty easy to understand. And then one other model, actually this is in your book, but we're not going to deal with this. And the reason is this gets a little bit technical, and so I think it's probably a little bit beyond what we need to do in this class. So you're not responsible for the non-constant growth model, okay? And as the name implies, it assumes dividends grow at a non-constant rate, so it's just a multi-step model, but you're not responsible for it. So you're just responsible for the zero growth model and the constant growth model. And then when you come back on Tuesday, we're going to talk about the efficient market hypothesis, and we're going to talk about investing. I'm going to bring the screen back up that you looked at. We're going to talk about how to get started investing, what to look for, all of that. So, are there any questions about chapter 7 to this point? All right, have a great weekend. Have a safe weekend. I will see you back here on Tuesday. Oh, let me remind you also, on Tuesday at 4 o'clock in the stable is our financial literacy event. So a lot of good free stuff, a lot of free giveaways. Try to plan that. Bring as many friends as you can.